Hello, everyone. Welcome to the Brainless Investor YouTube channel. Today, we will cover what is first in, first out, or known as FIFO, how does FIFO works, and the pros and cons of FIFO. First of all, let's understand what is first in, first out, or known as FIFO. FIFO is an inventory valuation approach where older stock is sold before newer stock is added. The earliest products acquired are the first to be sold. The FIFO approach ensures that the most recent items remain in stock. The expense for the inventory bought initially will be acknowledged first under the FIFO method. FIFO is different from LIFO, which is last in, first out, which is an accounting approach where the most recent acquired assets are the first to be sold. FIFO operates on the premise that the cost of the oldest asset are reflected in the cost of goods sold, or known as COGS, in the income statement. So how does FIFO work? The FIFO approach is utilized for determining how costs flow through the accounting processes. As products move through various stages of development and their finished version are sold, the associate costs should be recorded as expenses. Under the FIFO method, the earliest purchased inventory costs are recognized before others. As the inventory is sold, the total value of the inventory owned by the company declines due to the items being removed from their asset. There are different methods to calculate the cost linked to inventory, and one such method is FIFO. The common economic conditions are characterized by inflations and increasing prices. In scenarios where FIFO applies, the cost from the oldest inventory will generally be lowered compared to the newer inventory bought at inflated price. This results in a reduction in expense, which in turn lead to increased net income. Consequently, the ending inventory is shown at a higher value. Let's move on to the pros of FIFO. It is simple and logical, easy to understand and implement, matches the natural physical flow of many products such as perishable like foods or medicines. Second is higher ending inventory value. During inflation, FIFO results in ending inventory that reflects more recent, higher cost, which is better to represent the current market value. The third one is lower cost of goods sold, COGS in inflations. Older, cheaper inventory is used up first, which leads to lower COGS and higher gross profit and net income. It complies with international standards accepted under both IFRS and GAAP, making it suitable for global businesses. It minimizes obsolescence. Because the older inventory is sold first, there is less risk of item being obsolete or expiring stocks. Now, every pro has a cons. Let's look at the cons of FIFO. The first one is higher taxes during inflations. Because profit appears higher, company may face higher income tax. Secondly, it may not reflect the actual cost flow. In some industries, the actual inventory may not follow FIFO, example technology, fashions, where newer items might sell first. The third one is less matching of revenues and expenses. Older costs are matched with current revenues, which may distort profit margins during times of significant price changes. The fourth one is inventory management complexity in software. While conceptually simple, tracking individual purchase layers for large or complex inventories can become complicated without a good software system. Let's take a look, for example, of FIFO. So say, you bought 100 units at 1st January for $10 each. Then 10th January, you purchase another 100 units for $12 each. Now suppose the company sells 150 units on January 15th. Under the FIFO method, the first 100 units sold come from the January 1st batch is $10 each. The next 50 units come from the January 10th batch, which is $12 each. So cost of goods sold is 100 times 10, which is the first 100 that you bought at $10 plus 50, the remaining 50 units you have to sell, times the next one that you bought on 10th January, which is $12 each. And then you have 1,000 plus 600 equals to 1,600 US dollars. The ending inventory, the remaining of the 50 units from the 10th January that you purchased is $12, equivalent to $600 USD. To end this video, let's look at how FIFO affect the accounting books, right? Um, Cost of goods sold during inflation is lower. Net income during inflation is higher. It has higher taxes. Inventory value on balance sheet is higher, more current prices. The risk of obsolescence is lower and is compliance to the IFRS and GAAP approved. We hope you managed to learn a few things about FIFO. If you enjoyed this video, please leave a thumbs up and subscribe to our YouTube channel.